Hi there. So in this video, I'm going to talk about the tax considerations when purchasing an LLC interest, or actually I'm going to be more specific than that. I'm going to talk about one particular tax consideration because there's a number of considerations that you might have to consider when buying ownership or even just part ownership in a business. And if you're buying somebody else's LLC membership, there's one more thing for you to consider on that you may not have, and that's what I'm going to talk about. This discussion that I'm having assumes that the LLC that we're talking about is being treated as a partnership for tax purposes. If the LLC you're buying into has already been operating, you should discuss the option of making a Section 754 election with your future partners. Now, they may have already made the election, which is fine, and then you're all set to go. But if not, then that would be where you would have a discussion about this, because this election will allow you to claim additional tax basis on the assets that are inside the LLC. And the purpose of that is so that you can deduct additional depreciation or amortization on your income taxes as a partner in that LLC treated as a partnership. An operating LLC will usually have depreciated assets inside the business, and what happens then is that the tax basis of those LLC assets will be less than the value of the LLC. So for example, assume you have an LLC with a total value of $1 million and its assets have already been depreciated to a tax basis of only $500,000. When you go to buy 10% of that LLC, 10% of the membership units, you would have to pay 10% of the total value, right? So if it's $1 million and you're buying 10% of the membership units, presumably you have to pay $100,000 to buy into that LLC. Your 10% of the inside basis of the assets, though, would only be $50,000. So follow that if the LLC had depreciated the basis of its assets down to $500,000 and you're buying 10% of that LLC, then your portion of the inside basis of those assets is only $50,000, even though you're paying $100,000, because you don't pay a price that is equivalent to the tax basis of a business. You pay a price that's equivalent to the value of the business. So you pay $100,000, but you're only getting potential future tax deductions, at least through depreciation, amortization, and such, of $50,000. And that if you don't make a Section 754 election to remedy that discrepancy, then you're at a disadvantage as somebody buying into this partnership, because you've paid that $100,000, but you're only getting the tax deductions of the $50,000. And what the Section 754 election is designed to do is to help make you whole on that issue. You can't make the election individually, though. The partnership needs to make that election. And so you need the pre-existing owners of that partnership, or LLC taxed as a partnership, to agree to make the election so that you can get that benefit. Once the election is made, it's binding on future transactions. So it's possible that the election was already made and you can just get the benefit of it already, but that's something that you would have to check on. The effect of the election is that your LLC will step up your share, your personal share of the inside basis of the LLC's assets from $50,000 in our example to match the $100,000 that you actually pay for your outside ownership of the LLC. This additional basis that we're talking about is actually unique to you, and it's allocated to you. It's allocated to specific assets that can either be depreciated or amortized and reported specifically to you on an annual basis through your Schedule K-1 so that you can get the unique advantage of those particular deductions. How you allocate the step up among LLC assets. So in our example, there was a $50,000 basis in all the LLC assets, tax basis that is, the value was $100,000. If you make the 754 election, we're presuming that you'd get a step up of $50,000. There is a technical question. How do you allocate that, what I'm calling the step up, that increase in the inside tax basis of assets? You have to assign it to assets, and there is a procedure to do that, but I'll have to maybe tackle that in some other video so this doesn't get too long. But keep in mind, you don't get to just choose exactly which asset it goes to. It's procedural. And if you're buying somebody else's LLC membership, then that's where this would apply, right? So this doesn't really apply to buying buying into a partnership from the standpoint of if you're making what we call a capital contribution in exchange for new units from the partnership, then the 754 election idea wouldn't apply to you. Where this applies is when you're actually buying somebody else's units, you're buying them out, then this would apply. And so if you're doing that, check on whether a 754 election has already been made. And if not, consider making the election as part of your purchase negotiation. Okay, well, that's it for this video. I'll see you guys next time. I'm going to get back to gardening. Thanks.